Hey everyone, and welcome to this explainer. Look, I know you've seen the endless AI headlines by now. In fact, we've probably all seen so many of them that the massive numbers have honestly completely stopped meaning anything. Every single week, it's just another $100 billion here, another mega campus there, another record broken. It's just something you scroll past on your phone without giving it a second thought. But we really shouldn't be moving on quite so fast. This year alone, Big Tech is on track to spend more than $700 billion building out their AI infrastructure. That is a truly massive financial undertaking, which leads us to a huge, glaring question hiding right in front of our eyes. How are we actually paying for all of this?
Okay, let's dive right into this, because the answer starts with an absolutely jaw-dropping number: $1.65 trillion. That is what a recent study found that just 5 major tech companies owe in obligations. And here's the real kicker, the part that's truly wild. That money never actually appears on their official balance sheets. It doesn't. It's this massive financial mystery hiding entirely in the shadows, quietly funding the single largest infrastructure build-out in human history. When we compare their visible, on-the-books debt against these shadows, the picture is incredibly skewed. Those same 5 tech companies report about $1.35 trillion of debt on their actual visible books. So not only is the hidden pile of debt bigger than the visible one, in some cases it completely dwarfs it. Take Meta, for example. Their off-balance sheet debt is nearly triple the reported debt they actually show to the public. And, moving that much money out of sight isn't some cheap accounting trick you can just invent overnight. It requires a highly specific, highly sophisticated system. But before they took everything to the shadows, they did try to pay for it the normal way. On the surface, these big tech firms are the safest borrowers on earth, right? I mean, they're practically swimming in cash. For most of the last decade, they spent roughly 40 to 50 cents of every dollar they produced on capital expenditures, basically just reinvesting in their own businesses. But if you look at the numbers for this year, that figure has absolutely skyrocketed to 94%. They are running their entire cash engine just to finance this AI build-out. So they aren't funding it out of their massive vaults anymore. The build-out is completely, literally draining their vaults. So what happened when they finally started running out of cash? Well, they hit the bond markets, and they hit them with absolute desperation. Just to put this in perspective, from 2020 to 2024, the 5 biggest hyperscalers issued an average of about $28 billion a year in bonds. Then in 2025, that jumped to over $100 billion. And then 2026 happened. In just the first 5 months of 2026, they issued another $159 billion. Think about that for a second. In 5 months, they borrowed more than they had in the entire previous 5 years combined. It has gotten so completely out of control that major global institutions are sounding the alarm. Tobias Adrian over at the International Monetary Fund recently pointed out just how severe the systemic risk is getting, warning about these major tech firms leveraging up so aggressively. It actually got to the point where this tech debt so completely saturated the US dollar market, which is the deepest capital market on the planet, that the market literally couldn't absorb any more of it. There was just no room left. In response, these companies had to start borrowing in foreign currencies almost overnight, suddenly becoming top bond issuers in currencies where they had literally zero presence just a year prior. Now, when you max out the deepest capital markets in the world, you're forced to look somewhere else. And that brings us to a phrase that Wall Street has tried very, very hard to forget since the 2008 financial crisis: the shadow banking system. Coined back in 2007 by economist Paul McCulley, this refers to institutions that borrow and lend exactly like banks, but legally, they aren't banks. That means there's no deposit insurance, there's no Federal Reserve safety net to catch them, and none of the traditional regulations apply. Back in 2008, this exact machinery was built entirely on mortgages. Today, it is pivoted completely to data centers. So the absolutely crucial thing to understand here is how this machinery actually operates in practice. It runs on something called a special purpose vehicle, or an SPV. And here's the plain English version of how this works. Let's say a company wants to borrow a literal mountain of money without it showing up on their books. So what do? They create a completely separate company, the SPV. That SPV takes on the debt, it buys the asset, and then it leases that asset right back to the original company. It's basically exactly like opening a credit card in your cousin's name. You swipe it, you got the rewards, you enjoy whatever it buys, but when the bank comes knocking to ask about your debts, technically you can look them in the eye and say zero.
Seeing this theoretical machinery operate in the real world is genuinely fascinating. Let's zoom in on the biggest deal ever done, the blueprint that pretty much every other deal is copying right now. We're talking about the largest investment-grade project financing ever completed, a $27 billion multi-gigawatt data center campus in rural Louisiana for Meta. And it's all riding on a special purpose vehicle named, of all things, after a pastry, Project Beignet. Meta designs this place, they build it, they operate it, and they are the only tenant it will ever have. But that $27 billion in debt? Oh, that belongs to the pastry.
So here is the accounting magic that actually makes this possible. A private investment firm called Blue Owl Capital creates the SPV, and they put up 80% of the equity. Meta takes the remaining 20% and signs on as the tenant. Now, because of a single phrase in the complex accounting rules, sitting at 20% means Meta is legally not the primary beneficiary of the venture. And guess what? If you aren't the primary beneficiary, that $27 billion of debt just legally vanishes from your balance sheet. Poof, gone.
But actually, it turns out if you dig deep into the footnotes of Meta's public filings, the stuff literally nobody reads except for absolute finance geeks, you find this hidden fine print. It's a residual value guarantee of up to $28 billion. What this means is that if Meta ever decides to just walk away from the project and the building loses its value, Meta is still on the hook to write a check to the bondholders to make them whole. So they get to tell two completely different stories. To Wall Street, they say, hey, we don't own it. It's not our debt. But to the bondholders, they're saying, don't worry, guys. If this whole thing tanks, we will cover your losses up to $28 billion.
And the sheer precarity of this whole setup becomes incredibly obvious when you just look at the timeline of these deals. The bonds issued to pay for this hyper-customized Meta-specific supercomputing site in rural Louisiana, those stretch all the way out to 2049. That's a 24-year loan. But Meta's Vise? It doesn't even start until 2029, and it only renews in tiny 4-year chunks. You have a massive 24-year loan resting entirely on a 4-year lease for a building that is practically useless to anyone on Earth except for Meta.
Now, if this were just one deal, maybe it's just a weird anomaly, right? But Project Beignet became a template. Just recently, BlackRock started marketing a $12 billion sequel called Project Sophia for Meta's newest AI data center down in Texas. They're using the exact same structure, the exact same 80-20 split, it's just named after a different pastry. The shadows are rapidly expanding, and they're pulling more and more capital into these highly precarious off-book structures.
When you zoom out to look at the entire tech industry, the trend is genuinely terrifying. This off-book pile of debt has grown roughly 8 times over since just 2022. Moody's found nearly $1 trillion pledged in legal contracts for future AI data centers, with over $660 billion of that completely invisible on main balance sheets. Morgan Stanley now estimates that the total off-balance sheet exposure across the whole tech industry has exploded to a staggering $1.8 trillion. Which brings us to a really chilling 2-word quote from a lawyer who actually spent years litigating the fallout of the 2008 financial crash. He looked at this new system and he simply said, "Déjà vu." And why? Because it's the exact same small club of lenders on every single deal. When you have 5 major borrowers using one identical shadow structure, funded by the exact same handful of lenders, the risk stops being diversifiable. It's just the same exact bet written 5 different times. The last 2 times an entire industry standardized a financing structure this fast, we got the telecom crash of 2000 and the catastrophic mortgage crisis of 2008.
So what we're looking at here isn't really standard investing anymore. It's basically the largest, riskiest bet in human history, functioning like a massive 4-leg parlay. For this AI bubble to survive, every single one of these fragile conditions has to hit perfectly. Number 1, AI revenue has to aggressively multiply, not just grow, multiply, to cover these $700 billion in spending. Number 2, returns on cloud investments, which by the way have already slid from 40% down to 20%, have to stop shrinking immediately. Number 3, that massive $1.5 trillion borrowing window needs to somehow remain open. And number 4, the physical power grid has to magically absorb all of this completely unprecedented load. Every single leg of that parlay is stacked incredibly precariously on top of the other, all heavily funded by $1.65 trillion hiding quietly in the footnotes of public filings. Which leaves us with one final, deeply unsettling question to really think about today. What happens to the global economy if just one leg of this historic parlay breaks? It really is a multi-trillion-dollar house of cards, just hiding in plain sight. Anyway, thank you so much for joining me on this explainer. I'll see you next time as we continue to visualize and uncover the complex systems shaping our world.